Well, good afternoon, everybody, and welcome back to the end of summer as we know it. I think Labor Day marks the official end of the summer, so we're all kind of grasping for the last tidbits of summer. It's been a good one, very busy one. Ken, are you out of the mountains?
I'm out of the mountains. We came back. We had a quite an interesting experience with our rental down in the mountains this year, which I won't bore anybody with. But we came home about 3 or 4 days earlier than we expected. I was supposed to still be in the mountains today, but we're back and ready to go. So we're getting ready to take off next week for Traverse City and uh, just spend some real quality time when maybe all the kids are off the streets and in the schools by that time.
All right. Well, everybody, my name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and the voice you just heard was the magical mathematician of mid-Michigan, Ken Kavula. I get that right, Kevin? The
Really
four
new,
M's?
new
It,
titles
it was
all the
four.
time. All
It was
right.
four, but I went with magnificent
Magnificent.
mathematician from mid. Yeah, magnificent mathematician from mid Michigan. That sounds like that would be Mr. Kavula.
All right.
All
Let's
right. And the
let's
second voice you
continue
all
now.
heard was
Okay.
Kevin Galogly. Kevin is with our Baltimore, Maryland, and Washington, D.C. chapter for Better Investing. Welcome, Kevin. Welcome back.
Glad to be here.
And like I said, we're going to be grabbing onto a little bit of summer. We're going to spend a few moments with the alert settings that you can do at Manifest Investing. And I got tired of being very haphazard and just kind of hit and miss on a couple of the things that we do for the roundtable. So I'm going to demonstrate how we will always be nudged when the relative strength index goes high, basically nudging us into a selling evaluation. So that's one of the things we'll cover. And then we're also going to take a look at a little bit of shopping and that type of stuff, and just kind of wrap up some
When
thoughts that we've been kicking around here over the last few weeks as we head into basically back to school season also.
when we get there, Mark, I want you to show me whether or not there's a way I can do greater than 80 and less than 30 in the same line. Can I write uh, a criteria like that or not? I We'll have to see when you get there.
Okay, yeah, the alerts, I'm sure you can because I've done it, but
Okay.
I don't know if you can do that on screening. You might be thinking of the two
No,
together.
I'm thinking for the alerts, not the
Okay.
screening.
All right.
Yeah.
Well, we can take a look at that. And for those of you that haven't heard, Michigan did get hit with a whole bunch of storms. That's the celebration of the lightning, and then we were also talking about tonight as a bit of a lightning round. And since we do have a roundtable tonight, we do try to keep this session a little bit brief. And yes, that's a blue moon. We have our second full moon in August. I believe it's tomorrow night, coming at us here pretty soon. But the moons have been pretty good over Michigan here lately. All right. Here's our quick slide. Why do one hot dog when you can do three? This is just a quick reminder that Portillo's is not a sponsor of this presentation, but they should be.
What's your quality ranking again? I forgot.
Room for improvement. What's that? RFI. RFI. Room for improvement. All right. A lot of familiar names here, but in case you are here for the first time or you need reinforcement, no investment recommendation is intended. This is entirely about education, demonstrating and illustrating. We do an awful lot of demonstration stuff at Manifest Investing, and everything that we do here is for education and illustration. We are sharing opinions. Please do your own homework, complete your own analysis before you hit the buy or sell button with your broker. If we own something, we'll try to remember to mention that. And again, form your own opinions, make your own decisions about everything that you use. And we are not the boss of you. We do have a roundtable tonight. We have a reminder list that goes out for that event. It's a once a month webcast where we share 3, 4, or 5 actionable ideas for study. Please send in an email to nkavula1@comcast.net, and Natalie would be happy to add you to the reminder about those monthly webcasts, usually on the final Tuesday of every month, 8:30 Eastern time. So we do have that tonight, so we'll kind of probably step a little bit more livelier than usual. Our two emails are at the bottom if you have any suggestions for future topics or any questions or follow-up. Anything else, Ken?
Just, I don't want to have the other folks that in my investment clubs feel I'm leaving them out. So a shout out to the longtime president of the Mid-Michigan Model Club, Mary Reynolds, and a shout out to the longtime secretary of the BI Brighton Model Club, Sandy Cook. We're so happy to have both of you with us this afternoon. And again, we hope you get something out of the presentation.
All right. Good to see all you guys. All right, just a quick stop in on some long-term forecasts. This one happens to be the Value Line low total return forecast. We switched a few weeks ago just to kind of take a look at something different. The shape of the curves match the Value Line median appreciation projection pretty closely. It's been a tough August. Therefore, that green bar on the far right is a work in progress, and it has slumped down. It had actually peaked through and was sitting slightly higher than the blue line. And that has changed. And of course, that went down. The return forecast went up slightly on the right-hand side. Anything you want to reinforce here, Ken?
No, except that I'm crossing my fingers for a third up day in the market today. Things are looking pretty good when I left the television about half an hour, 45 minutes ago. So let's see if we can end on a high note in August here.
Yeah, I try not to look, and I usually look through gaps in my fingers, but sometimes I think I jinx myself every time I peek in there and see what's going on. All right. Here's kind of an interesting slide. We talk occasionally about housing and home builder, residential construction type markets and the investability of that type of stuff, but this one really shows what has the impact on somebody who is trying to buy a new house these days. It's a pretty powerful slide. When you look at, basically buying the same house and what you have to pay for it. And I was struck by what actually happens on the amortization. And that little blip down on the blue graph on the far right is not a very comfortable thing. And I just feel for the younger people that are experiencing that. And it actually is putting a little bit of a damper. That said, my sister put her house on the market this past weekend, and she had 3 showings before it was officially on the market. So not all is lost in the housing market for sure. Anything you'd like to add there, sir?
Well, I listened to a discussion amongst some talking heads this morning about inflation again, and was struck by the division in the population between people that were trying to buy a house or were getting into a brand new house and at the same time looking at a car, and the rest of the population. There's a pretty decent segment of the population that if they have a decent automobile already that they bought a couple years ago, and if they're living in a house with a mortgage under, say 3 or 4%, they're not experiencing nearly the inflation that you might expect. But there's also a significant portion of the population that fits the other camp, and that's the people that are getting all the press at the moment. It might be that group 1 is kind of holding up everybody while group 2 is doing a lot of suffering, I
think there's a lot of that going on.
Yeah, I have a hand up from Matt Spielman, our friend in Houston. And Matt, if you'll unmute yourself, you're free to speak.
All right. Hey, guys. Hopefully this is clear. I'm on new hardware.
Yep, we can hear you nice.
Great. I was just going to say, and I apologize, I don't have the citation, but it was a really interesting interview recently. I don't remember if it was related to an earnings call or something else, but with a home builder CEO talking about this. And it was interesting to me how asymmetrical it was. He said that when they were facing someone under contract who's looking to get or needs to get a mortgage now, that if he were to decontent the house or just reduce the price, it would take on a $500,000 house, he would have to take the value of the house down by $80,000 to just meet the mortgage rate as it is. But that they were able to make, and I was surprised because he said a permanent adjustment. They were able to buy down the mortgage, not all the way to the lows, but to a 5% range for $30,000. So he said that hurt, but there was a very noticeable asymmetry, an arbitrage opportunity where he could help the homeowners get a lower rate to essentially make a monthly payment they could afford. And it actually took less of a bite out of his bottom line than you would think, something out of, his price tag, basically.
Interesting point. I mean, it takes me back to the 1980s in California when we bought our house out there, and our company had to do a 3-2-1 buy down to help us out on the transfer. And I had noticed the buy down stuff increasing in mentions, and that would explain it, Matt. Very cool. All right, let's keep trucking. All right, Ken, I had kind of a rough night last night. Didn't get home till mid-morning, so I really needed something to kind of pick me up here. And
Needed a winner, huh? Okay.
we recently spent some time in Louisville and celebrated Secretariat. And I just wanted to point out, because I think I forgot to do this a month ago, that we did have that Run for the Roses, and you won the first year handily, and then I won the second year, and now the 3-year cumulative, call it the Belmont, if you will. Finally, kind of bringing it home there. I was kind of relieved to see First Financial actually has some green ink there. And I just thought, I just felt like celebrating a little something. So sorry if that's at your expense, Ken.
Oh, it doesn't make me feel bad at all, Mark. I was telling you before we started that I'm having a great deal of difficulty differentiating between the banks. I can't figure out why one would be so much lower than up here when I look at them and I see them basically having the same kind of fundamentals.
Oh yeah,
I don't think
it's
banks right now it's very difficult to buy a bank right now, I think. So it's just reality. This is a nicer list. I like this one better.
All right. Well, here's our groundhogs. We have had a couple weeks off, so I did add a column just to show where some of the drifting around is. Because when somebody moves from 34th to 16th place, it's kind of special. And I just wanted to kind of catch that and capture it. And so actually, Bruce Kovac moving from 51 to 30th is the biggest move on here. But we do have a new leader, new sheriff in town, Nick Pacini. I think Nick has actually led in the past, but he's a multi-year participant, so it's good to see a fresh name up at the top. And there's a pretty good. We're about halfway through, and there's a pretty good battle going on. Matt he remains in the top 10, lurking and dangerous.
This is live or die on Ardelyx, isn't it, Mark? Isn't that what's happening here?
There's some Ardelyx influence here for sure.
Yep. I noticed they came back quite a bit in the last month.
But I would hazard a bet that many of those bolded ones, which represent groups known as investment clubs for the most part, are there probably isn't a whole lot of Ardelyx in any of those, and they're really carrying a pretty good level of success there. Good, clean fun. Everything has kind of slipped back a little bit. I'm amazed that Kathy Wood has dropped from 50-ish down to 120th again. It's just amazing. All right, here's some of what you were talking about, Ken. We continue to be. We were talking a few minutes ago about how we do not look forward to Halloween, and we'll be cold-blooded honest about if we come in with a second year in a row losing to the general stock market. We're not going to lie about it. It hurts, and we want to try to put an end to a 2-year streak. So hopefully we'll have a good 2 months. We still have 2 months to go, but when we're depending on time-dependent catalysts, which can come home or not come home, like in the case of MP Materials, it's kind of rough. And as Ken was saying, some of those companies down there at the bottom, it's hard to reconcile the price pressure that they've been under. I particularly struggle with Semler Scientific. Wish we had taken Matt's company instead, but hopefully Semler will come through for us.
Well, this gives us a good basis to begin next year's list, Mark. There's that par column is still pretty strong. There's still a good 6 or 7 candidates for next year's list on that list right there. I will tell you that in 2 of my clubs, they both put significant funds into Technoglass in the last week and a half. Feeling that even though there's been a big run on the company, it has an awful lot further to go. I'm going to present Technoglass this evening and talk about some catalysts that might make the price on the stock seem a little bit tame and give it a lot of positive momentum. That's a teaser for you, okay?
There you go. I look forward to it. It's a company that I've been kind of intrigued about. I was always a little bit nervous about the northern South American connection, but they appear to be fixing some of that, and just perceptions. And we'll see. All right, so let's just kind of, everybody out there, click your heels together 3 times, throw some salt over your shoulder, and hopefully that red bar will start catching the green bar soon, especially with a new month. Okay, I wanted to jump back to this one. We touched on it last week. There's a number of funds that are in the oversold condition. Relative strength index shown there by that red arrow, down under 30, some approaching 20. And a lot of the companies that are associated or affiliated with electric vehicles, lithium, and that kind of stuff are struggling. But it caught my eye that those medical device companies right down the middle, those are some fairly successful funds. The second one is an actively managed fund. We're going to take a look at that. It just suggests there could be some opportunity there, so we'll dive into that one a little bit. But just be aware that there's quite a bit going on, quite a bit of oppressive pressure on these companies that are in the EV space right now.
Mark, do you find if there's a relative strength number that's too low, that we'd start to get a little bit too nervous?
Yeah, I think so. It's just like anytime you have a return forecast that's too high, it can be too good to be true.
What would that number? What would you sort of put that range and number at? I know it's not a hard and fast one.
Yeah, for a fund, I would say approaching, let's say 15. For an individual stock, probably down around 10, where you got to really, pay attention to what's going on. And, sometimes stocks drop for a reason. So that's what I would generally do. But this has been probably the most successful in terms of total return on selections that we've seen with our Fave 5. So it is an area of opportunity and potential for sure. And here's one of the ways we use it. Here's the actual fund, that Fidelity Select. Again, it's a sector fund or an industry fund, but it is at least semi-actively managed, and it's highly rated by Morningstar. You can see, on the previous page, these numbers may not seem large, but those are the outperformance, that 3.1 and 2.8%. Oh, that's over 10 years. These funds are 14% animals. And what that looks like on there probably isn't quite as dramatic as what you see here. The fund with fairly dramatic outperformance over a 10-year period. So the individuals managing this fund seem to pick good stocks. So what we do is we go to the Morningstar page, click on portfolio, and then drill down or dial down, scroll down to the holdings. And what we're looking for is companies that have been interesting to them recently. So we are looking for companies that have either a late 2022 or a 2023 first bought date, and then pay some attention to the share change over here also. So we're looking for companies that have been recently capturing the interest and attention of these particular fund managers. And I get kind of excited as I look down that list. I obviously know United Health pretty well, and there's a couple others on there. Agilon is actually a round table selection from a couple years ago, but there's a few new names on there. What are your thoughts, Ken, on what you see so far?
That's exactly what I thought, Mark. It's odd for me to look at a list of stocks that comes from something that's performing quite well, and these funds are performing pretty decently compared to a lot of their peers. But to see a list of the top holdings and to not recognize most of the names on the list is kind of exciting. What's not exciting to me is the fact that with their portfolio weights being down in the under 1%, that means that this fund is holding 130, 140, 150 different or more different stocks, and that gives me a little bit of pause. They're not ready to put a lot of money into anything. I mean, they increased Oxford Biomedical by over 900% in the number of shares, and it's still only 0.21% of the portfolio. So interesting.
Exactly. And one of the other things we pay attention to in a situation like this is this number right here. That 37% is a relatively low turnover. So there is a fair amount of conviction here also.
Yeah, I zeroed in on that as you were chatting. I was like, wow, that's pretty low turnover.
And it's a pretty good size fund too. I mean, for the type of fund that it is, that's a pretty good chunk that these guys are taking care of. So these are the companies, again, this is not all the holdings. These are the ones that were, again, just recently of interest. And that's what you're looking at here, just to give a feel for what might be here. And again, we're looking for respectable returns with good or excellent quality ratings. Actually, for a core holding, for a portfolio right now, United Health probably was on the cusp of making our list for 2048, just by the nature of the presence of the company and their long-term strength. And they've got pretty good numbers left to right on the page. Obviously,
and Mark, it's been such a reliable performer over such a long period of time. We've owned United Health in my Wolves Investment Club for a dozen years or more.
Right.
And it's been a very reliable. You can count on it to beat the benchmark, to do better than the average. You can't count on it to outperform, double or triple like these rockets do. But for a company this size to continually move in the 10.5, 11, 11.5, 12 range, that's pretty decent.
Yeah, and there's some pretty good companies on here. iRhythm is a company that we discovered. In fact, I think it was a small company a few years ago that we discovered by following Brown Small Company. And that one has actually done pretty well. You can see that the returns are down because the price is up significantly. It's also one of those that, I'm not sure where this comes from. It'd be kind of a interesting little audit or study on that one. Agilon Health is one of those medical facility providers that stands to benefit from the increase in all of our needs, especially with an aging population. And that is a round table holding that could get another closer look. The one here that kind of jumped off the page at me, though, Ken, was down here with the 20% returns and the decent quality rating. By the way, many of these are fairly early stage, and that explains the lower quality ranking. Again, not a whole lot of track record for some of these companies. So the early stage ones typically do that. Eurofins does not fit that description. And just taking a little bit of a closer look, my nutshell summary would be that these guys are possibly a Belgian Neogen, for those people out there that know Neogen over the years. And as you kind of scroll through some of the words over there on the right, you'll see many of the things that they do that are Neogen-like. This one would actually extend into some of the other businesses like Illumina. They would compete in many ways with Charles River. That's a company. Kevin, I believe you presented Charles River Labs recently.
Yes, I did.
It's an interesting company. Again, it's an ADR. It's not traded domestically. In fact, if you go to their investor relations site, you're greeted with you have to hold up your right hand and swear that you're an American and you haven't been coerced by the company to be there and all that kind of stuff. But the numbers look pretty good. This is Ukraine happening here in combination with the decline in COVID type stuff, because they did provide some COVID testing stuff. So between the decline in that and what happened in Ukraine, again, they don't see that as a long-term problem, and this is a pretty nice picture. So this one probably at least goes on my radar screen to take a closer look at and keep a little higher on the radar screen.
Now, Mark, the obvious question would be, if you decided you wanted to purchase this, where would you go to purchase this stock?
I have not tried to purchase it through Ameritrade or E-Trade or Schwab or anybody. If anybody out there in the audience has, perhaps you can reaffirm that. But I mean, it is an ADR, so I imagine it's covered by a number of places. So it could be that's some homework to do. I did not look into that. I was more concerned with that little bump down in 2022.
Okay.
All right.
Mark, with if we go back to that, so yeah, when I did Charles River back in June, I was sort of showing you how I wanted to find competitors, and I found Eurofins through that because I was looking for the company not by ticker symbol but by the name of the company. So with Charles River, and this showed up as a competitor to it. So, and yeah, it was like it's not in our database. So I'd be curious to see how one could purchase it, but you know, when we're trying to do comparisons, you can't do it.
Okay. I wonder if they may have. I'll make a note and look that up and put it in the forum if I can. If there is an actual other ticker that does make the Morningstar or Better Investing database.
One more company on that list before we leave it, Mark, that the community used to have a lot of interest in, and at a number of different points, I did some studies on it and everything, is ICU Medical. I don't know what's caused the quality ranking hit, because it used to be a much higher quality company than it is today. But I've put it on my short list here to take a second or third look at after kind of ignoring it for a long period of time, just to see what's going. The numbers, the value line low total return is intriguing. The price to fair value numbers are intriguing for that matter. So, but I do know that that was a mentioned quite a bit in the community 5 or 6 years ago, and now seems to be something we don't talk about very much. So.
Yeah, and again, from 35,000 feet, I remember those days. I seem to remember that they were very focused in rural and flyover hospitals, if you want to throw that term at it, and considerable amount of competition in that realm. Having said that, I spent several hours last night in Byron Center, Michigan, at a place that probably qualifies as very ICU Medical like, and boy, I wouldn't mind going there if I needed to be helped. So some of those rural hospitals are just phenomenal. All right. Anything else on this one?
No, I don't think so.
All right. So I invited Kevin to kind of close up our discussion on Arnold Bernard's situation. I think he's going to just capture some of our main points, and then we also want to spend a few moments with a tried and true George Nicholson-ism. So Kevin, go ahead.
Okay. Yeah. So we talked about this 2 weeks or so ago. And if you want to go back and look at the bull session from the 15th, you'll be able to see it. But I thought that this was probably one of the most interesting quotes out of this entire book. And again, this book was a transcription of his lectures to students at Baruch College in 1958. I went out in 1959. But yeah, it's just like, again, as I was reading this, it made me think of, again, Manifest with their quality and par ranking, where we can also look at it in terms of, up straight and parallel type of stuff, although we don't necessarily always have a projection with it. But still, it really sort of hits on those key points. So let's go on to the next slide. And this is sort of an extension. Mark, this is really Mark's slide. But again, in the book, they were showing the highest qualities. And the quality ranking that Bernard was talking about is sort of a precursor to what we now have in Value Line as a financial strength in the safety ranking. And they apparently aren't listed as that in 1958. But as Mark pointed out, in that red box, the highest quality, 9 of those 10 companies are still in business today. Only J.C. Penney has gone by the wayside. And then Mark also put together sort of a tracking of how they performed. And if you look at this, again, outside of J.C. Penney and now Hartford Insurance, all of them have outperformed where they've been. If you look at that relative return over on the far right of the screen capture on the right-hand side. So again, it made me start thinking again, it's like maybe I ought to do more and more quality and stay away from companies that tease me with dogs. But I digress.
The other thing that really jumps for me is go and try to pick 10 stocks. Go back 10 years ago and pick out 10 stocks out of an old Value Line and see how many of them are around 10 years later. And it's just phenomenal that these are around. At the time I did this, 60 years later. It's just amazing.
And that's exactly what Bernard talks about, and what that quote is on the previous slide is it really tells you where we are and what's going on. So we can move on.
Ken, did you have some juice you wanted to heap or anything?
No, that's I'm just listening to the dog comments. I'm appreciating them. Keep moving here.
So that inspired this. Go ahead, Kevin.
So what Mark asked Ken and I to do is, as we were talking about this, is after this book presentation, I know Mark had been thinking about is how do you look at stocks long-term, 25 years down the road? We all sort of came up with it, and I sort of did a manifest screen. I also did one through Value Line, but some of the ones that showed up for me are the ones that I've highlighted in green: Regeneron, Taiwan, Alphabet, ASML, Monster, and Edward Life Sciences. And I'm going to present Monster tonight. I've had a couple people ask me, so what's this core score? So I've highlighted that again for people that don't know. There with Monster is that I have it highlighted in red, and then Mark is just pointed. I just sort of added it up. So it's a great way to take a look. It'd be interesting if you use the manifest screen. Core is anything over 225. Maybe if you start screening for stuff at 250, 275, I wouldn't get too precise, but you can sort of play around with those numbers, but then getting a really strong manifest rank to take a look at it. And then also with, it's great to have that quality, but if there's no growth going on with it. And so that's going to sort of bring us into I'll talk a little bit more about the growth going forward. Here it is. Mark and I were talking about this earlier. I think, was it yesterday? Heck no, it was last week. It all blends together. But he was able to almost pull this quote as I was chatting with him as he was driving down the road. He goes, I think it was on page 85. And it's just like, no, it's page 82. But it's really, really interesting that this comes from the chapter, if you have this book, it's the one from the 80s. It's the Making Buy, Hold, and Sell Decisions as a chapter. And in there, they have a subhead that talks about danger in selling growth stocks. And this is George Nicholson talking 40 years ago. And it's like, it's well to avoid selling a security where sales and earnings are enjoying steady upward trends of more than 10% compounded annually. And, it's better to hang with those than to go in and out of it. And, I can say I have some examples coming up here of my 2 clubs, and where we have either tried to pull out of it or we did pull out of it when we should have stayed with it. So it's a great learning experience when you take a look at it. So let's sort of go forward with that. Unless Ken or Mark, you guys have anything on this?
Yeah, I know Ken has owned many stocks for 40, 50, 60 years. So, you inherited a few stocks too, Ken. You inherited. Yeah. What? I'll let him defend himself in a minute.
Thank you. Thank you.
But
Are you trying to say that Ken is a serial monogamous?
there you go. And magnificent. He's a magnificent mathematician. I
From
just wanted to make
Mid-Michigan.
a point because I love bragging about other people. And Hugh McManus gave the presentation on Regeneron last week. It occurred to me after he finished, and this is just amazing to me. He has owned Amgen, Lilly, Regeneron, and at least 2 or 3 others of that same type of company for more than 25 years. All of them. So like a company like Amgen, where there have been times when you might have thought about selling, it never crossed his mind. And as long as the company continues to grow, near double digits, I mean, the impact that can make on a portfolio. And Ken, I'll just defer to you and Cognizant from what, 20, 30 years ago?
Cognizant from about 25 years ago. Yeah, now. I did think, Mark, that when I read this quote, and I'm sitting with the book in hand right now, that there was something missing from it. And what's missing is the tail end of the paragraph on the next page, page 83, where Nicholson says, it is sound, however, to sell high growth rate issues in part in order to start a new tree growing. And to add to a security that has been held for a year or two and begins to show real promise. So Nicholson has, I think he's really good at giving permission when it makes sense. And so while he's telling you to avoid selling securities that are doing this, at the same time, he's giving you permission to sell pieces of these securities when you can put that money to work at a better performing security. I find what he says very comforting to fit the style of investing that I do, confirmation bias. But I also find what he says just good, solid common sense. That allows me to get rid of some of my Apple. It allows me to get rid of some of my NVIDIA. I told some of my investment clubs when I bought NVIDIA, I told them when I was really happy about buying NVIDIA, and I haven't had a chance to report back to some of my investment clubs right now the fact that I actually have sold some of that NVIDIA and put it to work in other places that I find to be fascinating and maybe even growth that's as good or better that I'm getting out of that NVIDIA stock. So I just think that rest of that quote is equally important, and maybe we'll put it on a slide at some point.
It's something we definitely can come back to. It makes a lot of sense. Well, Kevin, here's what I was kind of talking about when I was rolling down the highway, and you can almost put math to it. So we've got the magnificent mathematician here, so we can work on this algorithm. And
Len is here to make sure we don't screw up the math.
Yeah, absolutely. Well, one of the things that we do with our technique for using the return forecast as the selling and buying trigger is basically displayed for Monster down at the bottom of the page. We basically look for the price that would be equivalent, that would deliver money market rates, and that happens to be $74 under the current conditions. So we would sell above 74, matching the money market rates. But if you really listen to Nicholson, and this is what I was kind of getting at, well, if you're talking about a core holding and it's growing greater than 10%, maybe the fact that we really have been wrecked / spoiled by low interest rates for almost 20 years. I don't even remember the last time that interest rates were like this. So what I'm getting at here is for a core holding that kind of meets this description that you see in the center field there, maybe we need a device that would basically overpower that interest rate driven 5.1%. And notice the difference in price here. It basically makes it a little bit less of a trigger to sell this company by raising the sell above price, just using that lower interest rate. So again, I just throw it out there for discussion. Ken and I have been talking about when to sell rules for quite a while. What are your thoughts, Ken?
Well, I really like the idea that I proposed to you before we started the presentation. And when I read this slide, this came immediately to my mind. And that's that this zero that we're using was zero for a long period of time. And I liked the fact that the zero we were using was basically a past 5 or 4 or 3-year average. And it kind of compared to the fact that par values were also what we expected to happen, in the future 3 to 5 years. I'm suggesting that I might use a lower number than 5 as my trigger, because I'm going to try to anticipate interest rates for the next 2 years and look at the last 2 years as something that I can put into my average. Put the last 2 years, the current rate, and the two that I anticipate together, add them up and divide by 5 and use that as my target. I'm thinking to myself, the next 2 years, I'm expecting interest rates to go the other way, down from 5. I'm expecting 4, maybe even 3. So let's say they're 4 and 4, that's 8 and 5, that's 13, but I'm going to divide it by 5 because there's 2 basic 0 years in there. And I'm going to get a sell trigger of about 2.5, somewhere around there. When I'm doing math like that, I'm using a big red crayon, just like Mark is writing with on the screen right here, and I'm doing a lot of rounding off, and I'm using numbers that I'm just purely guessing at. But I think that trigger at 2.5 makes more sense to me than letting 5 be the trigger right now. After all, that we arrived at that 5, what, in less than a year's time? Didn't that? Yeah. The Fed has not been raising interest rates for even a year yet. So I'm just going to put that out there for some thought. Maybe it's the start of an algorithm for what the trigger should be, but I'm not comfortable with using the suddenly different trigger of 5 when we've had zeros for the last 15, 20 years, however long it's been.
Yeah. And keep in mind, we are talking about a subset. Kevin was talking about the core holdings. You are talking about a subset here, and I think it makes all the sense in the world under the current conditions to be quicker to sell some of the more speculative stocks. And that
absolutely,
this wouldn't interfere with that at all.
I'm really comfortable, Mark, selling speculative stocks when they move, below my par, when they move below average. I think that they're screaming at you to get out. And if you're buying on speculation, you're going to have more sales. You're going to be wrong more often when you're speculating. Fortunately, that speculation is only going to be occurring in 20-25% of your portfolio. It's not going to be occurring in 100% of your portfolio.
Good stuff. So, Kevin, does that rhyme with the careening off the highway I did while we were talking about this?
Yeah, it does. And I think, as you and I talked offline prior to even doing the book review, is that, when you read Bernard in 58, 59, or I finished reading The Intelligent Investor, which was written in 49, is that they spend all this time talking about inflation and the like. And we have to realize, and I mentioned it during the book review, is that, our currency was tied to the gold standard until 71, 72. And the person who did it was like an undersecretary in Treasury by the name of Paul Volcker. And then he eventually gave us a tight money supply under Carter, but continued through Reagan. And that's pretty much where we've been as a country in terms of our interest rates, really since Volcker, really, you could really say since Alan Greenspan, so the late 80s. And that's sort of been, we talk about a 5% interest rate and, people think, oh my God, it's worse. And if you look at the inflation rates over in the time when we were under a gold standard, the 40, 50 years prior to that, it's all over the place. So, I mean, we've really sort of been accustomed to these really kind of low interest rate environments that are really pretty consistent, absent the last, 2 years.
Okay, so
I will tell you a story, Kevin. In 1956 or 57, I was a paper boy. I had a paper route. My mother convinced me to join a Christmas club with Union Bank of Cleveland. And the whole purpose of the Christmas club was to have some money right before Christmas that you could spend on gifts for your friends and family. And my club required that I put $1 in the bank every week for 52 weeks, starting on December 1st and going to the next December 1st. And when I put that $1 in every week for 52 weeks, they would give me on December 1st of the next year $58. And they were claiming that that was 6%. Now, anybody that can do arithmetic know that was really a little bit more than 6% because you were just dripping your money in week by week. But rates were above 5% in 1956 and 57, and I can prove it by looking at my Christmas Club book, which I still have. Okay.
Do we have to have a hoarders people come to do an intervention with you?
I've been able to keep my mementos down to 2 boxes. My wife only gives me 2 boxes. Sorry.
Smart woman.
We're gonna work with that one come Christmas time. Trust me.
Okay.
All right. So Kevin wants to hear some more stuff here.
Yeah. So what I wanted to do is taking a look at stuff like Monster stuff, and I own it. We own it in one of our clubs, the Montgomery County Model Investment Club, and you can see up at the top that we've owned it. It's coming up on 4 years' time, and we've had an annualized rate of return of 17.7% coming through there. And periodically we have. I did not present Monster to my club. I'm not the stock watcher for it, but I've just been sitting there and watching this thing just grow, and it's just sort of like, okay. And sometimes our stock watchers will sit there and say, "Oh, the stock is they haven't gotten in the sell zone, but they certainly got it into the hold and the low hold, like a hold with like a 1.2 to 1 upside downside ratio." And maybe a 7 or 8% total return, and they sort of say, well, maybe you ought to consider selling it. And the answer is that it gets back to what we were talking about with George Nicholson: is if this thing's growing at this kind of rate, give it that longer leash that the two of you talk about when you're trying to pair things out of the round table. So that was it. My example always has been to Monster is to go back to my other club. If you see that, Happy Destiny, we had Dollar Tree, and we owned it for 13 and a half years. And our annualized rate of return is 21%. And I was looking at this in preparation for it. We sold probably a third of this in 2012 when it was selling at like $42, and moved it into other stuff. We eventually got out of it in 2016 because some of our club members, and there's a picture of the club members about a dozen years or so ago. So I'm about 20 pounds heavier. I like the fact that I have more hair on my head up there, and it's all pretty dark. But regardless of that, we got out of it at like 72, and I think it's now Dollar Tree is now selling at 120, 125, somewhere in that range. So again, it hasn't really doubled in that period. It's slowed down a little bit. But again, this is something that just really, every time we did a stock update on Dollar Tree, with the exception of maybe twice in 13 years, was it ever in the buy. And, we ran into the same thing with Regeneron. We just sold it. We held it for about just short of 2 years. We have it at 20.4%. And Ken and I, and Ken's in the lower left there, and he's on the call today. I see that. We were talking about this as we went on a road trip last week. And it was just like, after we heard Hugh talk about Regeneron, it's just like, boy, maybe we got out of that too soon. We were looking at some of the numbers, all the metrics on Value Line or on the SSG were showing that maybe it was overvalued. The total return was down. It had a little bit of a dip in the sales and stuff. And we said, let's, take that money and move it into something else. And maybe we pulled the trigger too soon. And so, yeah, I mean, in Dollar Tree case, maybe we got out at the right place because we had to give that to some of our withdrawing members, and we were able to, avoid having to pay a capital gains by selling it and by transferring it. And with Regeneron, it was just like, man, maybe we pulled out too soon. And again, Hugh made such a really good case for what was going on with Regeneron. So Ken and I were basically sitting there going, maybe we ought to reconsider it and bring it back up. But again, it's one of those examples. There's no right and wrong answer. And I think for people that are relatively new, they want to sort of get a decision that's sort of, red or green. And, sometimes there's a lot of yellow.
Absolutely.
Kevin, I want to just change the focus just a little bit before we leave that slide. Do you folks use iClub accounting software to generate reports like this?
This is Bibio.
Okay, well, my accounting is Bibio as well. If you're using iClub accounting software or Bibio accounting software, you can generate these reports that fold in the dividend if the company pays a dividend, and you can get an annualized return number for your entire portfolio. If you don't get a report like that maybe once a year to take a look at, your treasurer can put these reports together in literally seconds. And if you work with a computer and screen during your meetings, it's certainly an interesting report to flash up onto the screen occasionally to show folks how some of your long-term holdings are doing on an annualized basis. It's a great report, and it generates all kinds of discussion about buy, sell, hold that's very profitable a lot of times.
Yeah, and our Ken, again in the lower left there, he's our portfolio manager in both clubs, and he will sit there and put things up like this, so we do have these good discussions.
Yep.
Great context.
If you're not looking at these reports, just prod your treasurer just a touch, and they can get these reports for you. Like
not your treasurer. I'm the treasurer of both clubs. I have enough to do already. I think the portfolio manager needs to do it.
Prod somebody in your group to get them up there.
All right. And Kevin wanted to wrap up the highlights.
So these were basically from the inside back cover of this book from 58, 59. And if you look at this, he talks about there's sort of 4 attributes he was looking for: probable market performance in the next 12 months, sort of an early version of the timeliness ranking, which came about in the mid 60s. The appreciation potential of 3 to 5 years, most of us know where you can find it on Value Line. The quality or long-term safety record, it's either safety or it's financial strength, and then yield. And we've talked a little bit 2 weeks ago on how that yield was much more prevalent than what we have today. But again, as he sort of sits there, is if you go down that hyperlink down there, if you get these slides from Mark, Value Line has a YouTube channel where they have once a month where they have a stock to buy right now, and almost invariably with every screen that they start out with a safety ranking and a financial strength on the top end. So basically the same as if we were to use Manifest and have a quality ranking right there. And they start with that, and then they'll put in things like either the 3 to 5 year price appreciate, that price potential and stuff like that. They'll put in a timeliness ranking usually. And it's amazing how, even though the variables are slightly different than what they were 64, 65 years ago, they're still pretty close to where they are in terms of where Value Line is thinking. And I think the next slide or two I have on that will finish.
The August session is tomorrow, so if you want to check them out, and you can just go to YouTube and search for Value Line, you'll find it for sure.
So again, we were talking about this. So here, if we look at the Value Line from today, this is actually AbbVie, and if you look at this again, they're emphasizing the timeliness ranking that I have highlighted in yellow up there. You can see the safety ranking that's right below that. And actually with the timeliness ranking, you'll see the yellow box down there. A lot of people zero in when you get to the commentary down in the lower right. that's basically that last one is almost always talking about where it is on the timeliness ranking. And I think a lot of folks, when they do their updates, they immediately look at that. And you have to keep in mind that timeliness ranking is only looking out 6 to 12 months. And, you know, sometimes people, if you're thinking long term, those things can be off a little bit to be able to take a look. But again, this is a little different in terms of where it is with the yield stuff that's highlighted in green. AbbVie pays a much higher yield than most of them. If you see the summary and index is telling us that the medium yield is 2.2 and this one's at 5%. And again, you can look at the dividends per share that's highlighted in the statistical array. You can also see it over in the annualized rates where you have the percentage growth on it and where it is on a quarterly basis. So there's another one of it. The other two that sort of stand out is going to be, you know, where it is with the financial strength and the safety. And you can see those are the ones that are in blue. So financial strength in the lower right where Mark just marked it. And then also the safety up there. That's again where Bernard's talking about the sort of the quality rankings that go in with it. And then finally where he is on that 3 to 5 year projection, where a lot of us tend to look at that red box. It sort of is always focused in there. And again, right above that, about two years ago, maybe 3 years ago, they put in this 18-month target price that's right above that. You know, so those are, you know, that's something to sort of take a look at things there. But overall, you can see that these four metrics are still pretty much in play 64, 65 years later. They've tweaked things a little bit, but again, it gives you a really pretty good idea of where it is. And if you take the summary and index and you can compare this. So in this case, AbbVie, again, these aren't sort of an apples to apples because this is a January 2021 value line for AbbVie and not the one that would be current for August of 2023. But you can sort of take a look at that, where that red box is, and compare it down to that summary and index, where it's a 55% over on the right-hand side to take a look at things. So you can sort of see they're sort of pushing it. And here again, that we talked about this 2 weeks ago, and their formula for what is a value line changed really almost a little bit each time away. So this is an early version. This is a 1943 value line for General Electric. And he was basically visualizing where he wanted it on the fit. And again, it was basically a book value per share plus 12 months of earnings was how he was setting it. And again, you know, he takes us out to 1958, just doing those same projections. And again, you can see that they hit pretty close to where he thinks it ought to be. Those price bars there are the prices as they actually happened. So you can see where his projections are just taking it out. And then you go to the next one, he modified it around 49, where he sat there and he added more of a rating formula, and he added dividends and earnings and sort of a price, like pretty much a momentum play. He was using, what do I want to say? He was using the moving average was sort of his lag prices. So you can see he tweaked it along the way in terms of where he was going with this. So from when he first did it, and now you see it here, and now we talk about cash flow. And you got to remember, people talk about cash flow, but remember, it's not really the cash flow that we talk about. It's a cash flow in quotations. So again, it's the net income. You're going to have to add back in the depreciation and amortization, and then you know, you can sort of figure it out. And that's how they measure it now, is on this air quotes of cash flow. So and now, instead of being set by hand, it's set by a regression analysis that goes on with it. So they've sort of tweaked things along the way to adjust for things as they had more data and more computing power. But it is kind of interesting to see, again, the premise of what they're trying to do still is pretty true to where they were when they first started bringing out these, his first list of 100 stocks that he was evaluating in 1937. So that was really it. So yeah, you can see how much it's changed over time. You know, they I've discussed it. You can see how they expanded from 804 stocks when they did this book It's now 1,700. You can see, again, there was no expanded edition, the small and mid cap. There was no selection and opinion. Both of those came in the late 80s. Yeah, there's a lot of things that have changed, but overall, the tenor is still not too far off from what we're thinking about in terms of our quality. So that's really it.
Good stuff. Well, thanks, Kevin. All right, I did want to just take a moment and point out something that I've been remiss in not doing a little bit more of. I get kind of haphazard and fly by the seat of the pants about stuff. Well, within Manifest, you can actually set alerts on a number of conditions, and those conditions are listed in this list on the left-hand side here. And the one that I wanted to focus in on for the roundtable, we've got quite a few stocks on the roundtable, and we just simply would like to know. Again, it's not an automatic sell nudge, but it's certainly an automatic sell, take a look at it nudge. And you can go to any company on Manifest, go to the company report page, and click in under this add alert button. And you get all of these options. And what I've done for all of the roundtable stocks now is gone in and entered. I just want to know, 70 is actually regarded as overbought, but seriously overbought from our perspective is 80. So in this case, Jazz is actually in the 70 range as we speak. It's the highest RSI in the roundtable portfolio right now. And if it actually goes above 80, I will get an email, and it also will display on the dashboard. And it basically triggers in and locks in until you actually pay attention to it. So that's the way it works. We'll start that as a policy going forward, and we may do a little bit more tinkering here, Ken, with quality drops and that kind of stuff. Things that make sense. Again, it's really a matter of literally thinking out loud, saying, what would I like to know when what happens? In this case, I would love to know anytime a company in the roundtable tracking portfolio goes above 80. I'd also like to know if we have a watch list, if it drops below 30 or 20 also. So is this kind of what you had in mind, Ken?
That's exactly. I've already been doing this for my IRAs, Mark, for a large number of years, but I haven't been able to use RSI. I was using par values up until RSI moved into the database. Okay. What I'm asking now is, can I use RSI on a second line in Manifest? In other words, I'd like to have the alert for less than 20 less than 20 or greater than 80. Can I write that sentence in any way?
I think you can. Hold on. So if we actually go into Manifest, go into Jazz. If we can't, we're going to make it that way. You see, I have the option to edit alerts. So I get this screen. And yeah, Ken, I think you can. You can put 30 in here.
So I can use both of those lines without any problem then, right?
You get either one. And then, for example, if you'd like to know, like, Silex to be alerted whenever a company that's climbing in financial strength, crosses through and remains above the equivalent of a B++, he likes to be nudged and told about that. So yeah, it looks to me like it can be done, Ken.
I will tell you, when RSI first went into the database, I tried both lines and I was getting errors. But if I can do it now, that's great.
Okay,
that's tremendous.
If we do get an error, we'll spend some TLC fixing it, because it's definitely a worthwhile thing to have. And again, for those of you that are not familiar with RSI, you can it's Relative Strength Index. Just look it up. You can Google it. You can look at it in the glass, or just search on it on the Manifest site. We've talked about it a number of times. It's overbought versus oversold. And again, we're watching for these opportunities for when a company crosses up into the 70 or 80 range on relative strength. Is it an opportunity to sell? Maybe do one of those partial selling and plant a new tree type things that Ken was talking about. So that is literally what we're watching for, and using the power of the tool to do that. I consider it to be prudent. And Ken, once again, you are a magnificent mathematician. You're better than me if you're already doing this.
I will tell you that, Mark, I've used these alerts for, I don't know, 7 or 8 years, and they have been extremely helpful. Not so much in buying, in adding to a position,
Mm-hmm.
but they've been very helpful in selling at opportune moments. And that's as important sometimes in a portfolio as buying.
Yeah, and the one time I shared, this has been dramatically profitable for Wendy and I. I'd always wanted to own Novo Nordisk, and I put in I want to know when the par goes above 10 or 12 or something like that. You know, not reaching for the stars. It rarely ever got that high, but it finally did after a number of years, and I was triggered into making a purchase, and oh boy, has that been a good one. Okay. Coming attractions, we'll continue with the alerts. We'll refine them a little bit, but we are going to talk about the hydrogen economy, the thrift savings plan, the blind leading the blind in the realm of investment education. And with the coming of Labor Day, it really does officially kick off our 2-month hunt for the best small companies we can chase down. So that's up and coming.
Folks, if you're coming to Bull Session about that thrift savings plan, that one's going to be coming up fairly soon. So we'll try to keep the paragraph current on Manifest that tells you what the next Bull Session's about. And I know there's 4 or 5 of you that are specifically interested in that thrift savings plan. So we'll get there just as quickly as we possibly can.
Absolutely. All right, just your quick reminder that we do archive all of these sessions, including the roundtables, on YouTube. So you can just go to the Manifest Investing page on YouTube and access them. Just a moment of celebrating a little bit of lightning. This is on the West Coast. I don't know if that's San Francisco or not, but I was also interested to learn that Florida has the highest rate of lightning strikes in the country. And we had several storms. Ken, while you were down in the mountains, we had a storm like this you wouldn't have believed. It was like daylight outside at 2 a.m. because there was so much lightning.
My sister who lives in Canton was telling me the same thing, that it was just striking on a continuous basis. The rumble of thunder was continuous for, she said, about 90 minutes or so.
Yep.
So
it was amazing. And we also got 3 inches of rain in like an hour. So tough. All right. So with that, I think we can go shut down. Are we good with questions and everything, Ken?
I think so. Steve Emmerich is giving us a shameless plug for I'm going to guess the HOIC is Heart of Indiana.
Oh, no, Illinois.
Illinois.
Heart of Illinois. Boy, I'm sorry about that, Steve. Heart of Illinois.
The Illinoisans are going to catch you on that one.
I know. Heart of Illinois on Wednesday morning, they have a program called the Breakfast Club. Now, Steve will expect you to advertise the Manifest and the Roundtable in return, but we're happy to advertise anything that we can put up here that's free. And frankly, we're one community, and one community, when it works together, pays dividends to everybody then.
Very good. I think I'll drop in on Steve tomorrow. In the Heart of Illinois Investment Club. They're the ones that are notorious for the Beardstown ladies.
I'm going to be at the dentist tomorrow at that time, but I will drop in next Wednesday, or try to.
I don't even want to think about the dentist right now.
I went to the dentist yesterday.
There we go. All right, gentlemen.
Reminds me of a line towards the end of his life of Chief Justice William Rehnquist. He was filling out his stuff with the doctor's office and said, "Who's your primary care physician?" He goes, "My dentist."
That is so true. That is so true. All right, guys. See you tonight.
Good night.
Take care, everybody.